a 16-gallon tank, which many cars do, you're looking at $4 to $5 extra per fill-up for that end-of-summer road trip if this becomes serious and affects the flow of oil. Let's zero in on this a little bit. My old friend Stephen Schork is with me now. He's the editor of the Schork Report. It's a site that offers fundamental and technical analysis of the energy markets. Stephen, what are you expecting to happen with respect to oil production?
Well, we've been talking, Ali, now for the past few days to clients in the daily report with regard to the crack spreads. The crack spreads are simply the differential between crude oil, the stuff that goes into the refinery, and the products, gasoline, diesel fuel, so forth, that comes out of the refinery. So in a situation like this, when you have a refinery that shuts down, that means they're not buying oil, they're buying fewer barrels, and they're boiling fewer barrels. So this tends to be a bearish event for crude oil. Conversely, if I'm putting fewer crude oil barrels into the refinery, I'm taking fewer gasoline barrels out of the refinery. So this tends to be a bullish factor for the product markets. And that's exactly what we've seen over the past couple of days. A lot of speculators have moved in trying to take advantage of this event. So now we have to watch for this weekend, because this is a significant event, obviously. Now, we're talking about 1/3 of every barrel of crude oil that is refined in the United States is now in the direct path of Harvey. When we factor in the refinery assets along the Louisiana coast and the potential tropical storm and flooding issues that persist there, then we're talking about 4 out of every 7 barrels of refining capacity, and this is refining capacity east of the Rockies. So as far as the New York Mercantile Exchange is concerned, this is what we are concerned with. So now we know this event has been priced in. How long, how much higher prices can go is now really going to depend on. We've had an orderly shutdown of the capacity of the industry, so that's all well and good. Now we have to watch the wind events, the flooding events. If we have any sort of prolonged shut-in of these refineries, then clearly this will continue to be a bearish event for crude oil. And going into, as you said, the Labor Day weekend, this will be certainly a higher price environment for motorists around the country.
So this is an interesting point. People may see the price of oil getting lower because we're taking less of it out, but that doesn't mean your gas prices. Typically, we associate lower oil prices with lower gas prices, but in this case, lower oil prices could result in higher refined gasoline prices. You didn't talk about the orderly shutdown. The oil industry is very good at this. They get their workers off the rigs in helicopters. They do it ahead of time. They seal up their rigs. Bottom line, though, is there is some permanent damage that can be done with a Category 3 hurricane to either pipelines, refineries, shipping channels, things like that. So this could have longer-term effects on gasoline price. And when I say longer-term, longer than a few days, on gasoline price and potentially access to gasoline.
Right, absolutely. And so what we go back to in a case like this is we go back to history. The last time that a significant amount of Gulf Coast refinery assets came under threat occurred back in 2008 when we had Hurricane Ike in the middle of August, and 2 weeks later we had Hurricane Gustav. It came right into the heart of the center. And what happened, and this is interesting, Ali, is in between August 15th and about the middle of September, the crude oil contract on New York Mercantile Exchange dropped by 25% in price. But in the final 4 days, when that contract went to expiration, it rallied 44%. And on the final day of trading, it went from a range of $103 all the way up to $130, a $27 barrel range. And this was a massive short squeeze. So what happened? And what happened there, Ali, is the traders went back and looked at what happened of the prior event. And that, of course, that would have been Katrina Rita in 2005. Again, this was an event that was ultimately bearish for crude oil prices, bullish for product prices. And so they went ahead and they put the same trade on. But for the speculators, they have to be very careful here because they have to realize who they are selling to. And a good deal of the people buying the futures contracts right now are people who intend to take delivery of this crude oil. That is the refineries that no longer have access. And these would be refineries basically up in the Chicago area that get their oil via the pipes and the ships coming in. So it creates a very dynamic, a very volatile market area. But the bottom line is, yes, to your point, people might look at a significant drop in oil prices and wonder why they're paying higher at the pump, and that's simply because we're just not making enough gasoline for the next couple of weeks. And this could be, again, if we shut down a refinery for a couple of weeks, this could be a lasting event well into the fall.
Yep. Yeah. All right. And we're going to keep a close eye on that with you and your analysis that comes out of there very regularly, which we appreciate. Stephen Schork, editor of the Schork Report.
Thank you, Ali.
All right. Coming up next, after drafting a letter of resignation in the wake of President Trump's response to the deadly Charlottesville rally, but not sending it,